Well, so good to have you along today. Today is Monday, and we will be talking about two different things. One is estate planning, and I'm going to talk about basics, documents that you need in your estate plan that I'm just finding people just don't, no matter how much they pay, no matter how much they try. There are some things that are missing, and I would love to talk about that today. And then we have, because it's our tax Monday, we're going to have attorney Rich Mathurin from GQ Law. He's going to come in and talk to us about tax situations, specifically unfiled or late filed tax returns, and what, if anything, can be done if you have not filed your tax returns for a while. Going to be going over that. So that's kind of an interesting topic, especially because we got the extended tax deadline coming up October 15th, which means that we are only about a month and a half away from that. So most tax professionals are hunkering down again to finish up their kind of third charge at getting the tax returns done by the deadline. So that's going to be what we got coming up here on the show today. If you want to be part of the show, we'd love to have you call us. The number is 888-344-1170. 888-344-1170, and you can be on and ask me the questions you want. Okay, so that you know the rest of the week, and most of you do. But what we're doing is tomorrow we have Tuesday, I'm going to have a reverse mortgage expert, Shane Sletter. He was a guest with me a couple weeks ago. We're going to have him on again because I've got some questions for him, and he has graciously agreed to come on the air with us tomorrow so I can pin him down on a couple of questions that I want to ask him. And of course, I'll let you answer some questions or ask some questions also. Wednesday, real estate. Thursday, investments. Friday, Finding Joy Friday. All right. Welcome to Monday. We've got 10 documents in your estate plan that you have to have. There are a lot more than 10, but I wanted to pin it down to 10. The thing to do with this is kind of inventory this in your mind on, do you have these documents in your estate plan? And if not, why not? And if not, how to get them into your estate plan. The first is pretty basic, and that is you need to have a living trust. Okay, if you don't have a living trust, then what do you have? Do you have a will? Do you have nothing? If you don't have a regular standard living trust, you can have a retirement protection trust or an IRA trust. Those documents, either the living trust or the retirement protection trust, those can both serve the purpose that you need. And that is, it can take care of you and your affairs and your loved ones during your incapacity and after you have passed away. So they're really good to get that taken care of. We talk a lot about trusts and living trusts and retirement protection trusts and IRA trusts. They're basically different types of trusts that have different purposes that they serve. When you have a consultation with me, which I offer a free initial consultation with all of my listeners, we will talk about the differences between the type of trust and what would serve you best. It's not, in my opinion, a matter of just saying, do you need a trust or not? It's, do you need a trust? Probably yes. And then the next question is, okay, what type of trust do I need? Do I need a family trust? Do I need a retirement trust? Do I need an asset protection trust? Depending on what your situation and circumstances are, we can talk about all of those things, figure out ways to go. Okay, the second thing that you need in your estate planning binder is your trust certification or certificate of trust. That's the same thing. And that document is used for when you go to the bank, you have your trust and you want to put a bank account in the trust, let's say. So you're going to go to, let's just say, Chase Bank. If you go to Chase Bank, they're going to say, all right, welcome to the bank. What can I help you with? And you'll say, I want to open a trust account or a bank account for my trust, whatever the way you say it. And if you don't say it right, they may open up the wrong type of account. Oh, a trust account. Oh, who's this trust for? It's my living trust. It's my trust. Oh, you want a trust for or an account for your living trust. So make sure when you go to Chase Bank that you take some documents with you, which I'll tell you in a second, and that you tell them, just lay it out. I have a living trust and I want to put my money in my living trust. I have money with you and I'd like all of my bank accounts to be in my trust. They will send you to new accounts to open a new account in the name of the trust. And they're going to ask you, well, do you have your trust certification with you? And that's when you whip out your trust certification and say, I do. And that trust certification will tell them the name of the trust, the initial trustees, which are you guys. It'll tell them what they can use for tax ID number, and that's going to be your social security number, either you or your spouse. Either way, doesn't matter. And it's going to ask a question on whether or not you can act independent of your spouse. That's critical. If you don't have that, then then Chase Bank is going to make you get a statement to that effect, or get something to say that. We've actually put it specifically in our trust certification, so there's no question that it can be done. Okay. Those are the first two documents: the trust, the living trust, and the trust certification that goes along and certifies that the trust does certain things, and that's what the bank wants from you. Number 2 or 3, that would be, is you need a will. Yep, you heard me say that right. Even if you have a living trust, you're going to need a will, because without that will, you may have property that is outside the trust that we can't figure out what to do with, because we're going to have to go through intestacy, which means died without a will, and try to figure out what happens with some of your stuff. But why do you have a will with a trust? First of all, the will, when you have a trust, the will is called a pour over will. Like pouring it out of one bucket into another, or pouring it out of a pitcher into a glass. It's called a pour over will. The whole purpose of that document is to take any assets that are found outside of your trust after you die and put them in, pour them over into your living trust. So it's a very specific document called a pour over will. And that pour over will is going to help you get all everything in your trust after you pass away. The other thing that's important is number 4, and that is the guardian designation. Okay, where do you put a guardian designation? There's like 3 different places. What I recommend is make it easy. Put it in your will. Okay, that's another reason to have a will. Guardian designation goes in the will, and it says, if when I die, my wife is deceased already, my husband is deceased already, then I want this or this person to be the guardian of my minor children, and you name people. Okay, makes sense? So you got to have guardian designation. That's going to be in your will. You're listening to Word on Wealth with Gary Quackenbush, and we'll be back in a moment to continue our list of 10 documents you need in your estate plan.
You don't need to know everything. You just need to know where to find answers you can trust when you need them. Welcome to the Word on Wealth with Gary Quackenbush. We're here to help you build, protect, and transfer everything you've worked hard for with expert estate planning, trust administration, inheritance, and probate. Call Gary and the team at gqlaw.com, 855-500-TRUST. You're saving and investing for the future, and that's good. Have you ever stopped to think, where does my money actually go? This is faith-based investing with Anthony Wright.
Most Christians just don't understand that the money they save for retirement usually helps fund the abortion industry and other liberal anti-family causes. But did you know that with just a few minutes of your time, we can screen and clean your investments at no cost to you? It's absolutely complimentary. Just go to the website right now, download a free copy of my book, Faith-Based Investing. It's free as well. You deserve to know the truth as the investor. Then the choice is yours. You can keep doing what you're doing, or you can line up your investments and life savings with your beliefs. We are fiduciary investment advisors. You can feel good about investing with confidence. So learn more now. Go to BibleSafeInvesting.com or call me at 931-RETIRED. Your free book is waiting for you. Go to BibleSafeInvesting.com and be sure that you listen to Faith-Based Investing this weekend right here on Family Talk.
Gary, your team at GQ Law are experts at solving IRS and state tax problems. Talk about that.
When people have a tax problem, it tends to really stress them out. And one of the things we've been able to do is figure out how to resolve tax problems. You know, one thing we might be doing is setting up a payment plan or getting a collection delay, maybe getting a determination that the person shouldn't have to pay the taxes at all. We do offers and compromise. We do audit reconsiderations. And one of the things that's a really powerful tool that some people don't recognize is sometimes bankruptcy can be used to actually eliminate taxes when there's certain conditions of the code that are met. So we can do all kinds of things after we analyze your situation. We can figure out what's available, discuss your options, and figure out which ones to implement, what it's going to cost, how long it's going to take. And we can get people out from under all kinds of tax problems so they can sleep again. That's our goal.
Request your free initial consultation. GQlaw.com, 855-500-TRUST, GQlaw.com.
Who will you trust with the biggest financial decision of your lifetime? If you're planning to buy or sell a home in San Diego County, do what I do and work with the true San Diego real estate experts. Ken Pecos and the Pecos Group helped me and my family. They can help you. This is Gary Quackenbush of the Word on Wealth. You hear Ken every week here on the Word on Wealth. He's our expert. He's got integrity, exceptional service, deep knowledge of the San Diego, Coronado, and South Bay regions. These are just some of the reasons that Ken Pecos has completed hundreds of transactions. He manages a powerful team of professionals at the Pecos Group. From single-family attached homes to luxury high-value waterfront properties to apartment buildings, Ken Pecos is ready to help you avoid problems and costly mistakes. Learn more online at kenpecos.com. That's Ken Pecos, Pecus.com. Or call 619-977-8419.
DRE number 010566969, brokered by eXp Realty.
You're not alone. Ask for the legal help you need. Call Gary and the team at GQ Law, 855-500-TRUST, or go online and download Gary's free ebooks and videos. Read Gary's blogs. Call or click to request your free consultation or to talk with a member of the GQ team. That's GQlaw.com, 855-500-TRUST.
And here we are talking about estate planning. We want to figure out exactly what documents you need to have in your estate planning portfolio. The reason we're doing this is because I don't believe that everybody understands what they need to have. I review a lot of estate plans for my listeners, and I go through this list and determine if they have all the documents, and many times they do not. And then we go through a recommendation list of whether I recommend that they have these documents, whether they get them created, whether you do a new trust, whether you start over, whether you amend, whatever you need to do to get it so your estate plan is in order. Keeping in mind, you guys, what we're trying to make sure is that in the 100% likely event that you die, your estate plan, your financial situation is in order. It's organized so that those that you leave behind, your loved ones and your family, will have an organized estate where they know what you wanted. The number one problem that I hear from beneficiaries is not knowing what their parents wanted, not knowing what their instructions were, because the parents didn't leave the proper instructions. And what I mean by that is they didn't leave like a specific distribution in a will or a trust. They didn't say exactly what to do with the car, with the household goods, with the jewelry. It's more like they didn't leave any instructions. They just said, my kids get everything in equal shares. That's totally normal. That's totally fine. But it gets really confusing as a child to say, well, then what? What do? We pile everything up and we pick through it, like do a random number generator and say, okay, sit in a circle and we're going to start out with the lowest number picked person and go in circles to the right, pick whatever you want. That may be a way to do it. I don't know. But what if there's something specific that there's going to be a fight over? I think parents need to leave specific or better instructions. If they don't care who gets what, that makes sense. If there's something special, though, that you're pretty sure there's going to be more than one kid fighting over it, you need to make a decision on what to do. Maybe you need to sell that asset while you're alive. Now, what did that happen to me? Good question. When my dad passed away, he had a 1955 Mustang, which I thought was awesome. It needed a complete restoration job, a lot of work. Well, I wasn't the only one in my family that thought that that would be awesome. And so my dad decided to part with it before he died. So we no longer have the Mustang in the family, which is super disappointing. But there's nothing to argue about. My dad made that choice, and he that was it. That was his final choice. That was done. He took care of it. But what I see with people is if you don't leave these instructions and you don't do a good job with your trust and your will, and you don't have any instructions left, or the will is not done properly, or the house is not in there, there's just some messy stuff that wasn't taken care of, it just makes things more difficult. And that's the number one complaint I get from kids. They say, Mom and Dad left a mess. We don't know what to do. There's, it's 8 bank accounts, and 2 of them were in the trust. The others weren't. There's a CD that's maturing, and it's $200,000. That's nothing to cry about. However, a CD maturing that's $200,000 is going to go through probate because it's big. What about the car? What did you want to do with all that? So it's just plan your estate. Just do it so that it leaves your legacy, your memories, it leaves them intact so that your kids feel like things are organized, and it sets a good example for them. Okay. The number 5 document that would be powers of attorney. We're going to talk about powers of attorney for money and healthcare. So first of all, money. Power of attorney for money. These are the things where, you've been listening for a long time to me, that this is kind of an area of particular concern for me. Power of attorneys come in multiple different kinds. You can have a general power of attorney, and general means it covers everything. A general power of attorney will allow the person holding the power of attorney, the person to whom power of attorney was delegated, they're going to have general power, which is unlimited power over everything. House, cars, bank accounts, clothing, personal property, household goods, timeshares, everything. So a power of attorney, a general durable power of attorney, will allow someone to have general authority, general power of attorney, general authority over everything listed in that document. And most of the time, a general durable power of attorney says everything, including but not limited to, and it goes through all these 15 paragraphs of telling you everything that it can do. You can buy and sell stocks and bonds. You can trade securities. You can open and close bank accounts. You can buy and sell assets, whatever. There's literally, most general durable power of attorneys are unlimited, which to me is absolutely terrifying. And it should never be that way, because if you have your property properly placed in an estate plan, which means it's in a living trust, and then you have your own will that's going to push things into the trust if something went wrong, and then you have a limited durable power of attorney that allows someone to move money into the trust if it wasn't there, if you were incapacitated. Those are the things that you need, and it makes it so that if it's done right, the general durable power of attorney is not going to be necessary. Now, sometimes there are situations where it would have been a good idea, but they're really rare. They're really few and far between, and that's what you need to talk to a professional about when you're talking about getting a power of attorney. Okay, so on my power of attorney rant, I had a situation. This was many, many years ago. A client has long since passed away. The situation was the mom decided that she would give her son general power of attorney, general durable power of attorney. Okay, durable means that even if mom were incapacitated, it is still valid. So what does that mean? That means if mom's incapacitated, she cannot revoke it. She can't even say, nope, I don't want him anymore. She can't change it. She can't revoke it. She can't alter it. It sticks. So what her son decided is that he did not appreciate his mother's behavior, and that she was going out and she would spend some time at restaurants, and sometimes she would go to bars, and she was in her late 70s and went into her early 80s, and she was doing this, and she was hanging out with guys and having a good time. Well, her son didn't like that, and she refused to listen to him. She had her capacity, she had her wits about her, and she just said, I can do what I want. It's my life. I'm being careful. I'm not doing anything stupid. I'm not being awful. I am just living my life because I'm getting old and I don't have much left. And he decided, with his general power of attorney, which was totally legal and legitimate, he decided that he would control her bank accounts. So he closed them. He went and took all the money out because power of attorney let him do that. And he also decided to restrict her from the home. So that was the big problem, is he went and deeded the house to himself because the power of attorney allowed that. So he went and created a deed with power of attorney and transferred the property to himself and then kicked her out. Now, you may think this is a joke. It's not. This is called a nightmare. So mom was very, very upset. She hired me to try to figure out what was going on, and we ended up coming to a resolution. But he was trying to control, and was doing a very good job now. He was controlling his mother's behavior with a power of attorney by restricting her from her own properties because the power of attorney allowed it. Why does Gary not like general durable power of attorneys? Because I just described it. If you give general durable power of attorney to anybody other than a spouse, that might not be a good idea. Okay. Think very seriously, very hard about what you need a power of attorney to do. If you have a properly set up estate plan with the wills, the trust, the power of attorneys, and all that stuff set up right, and those power of attorneys are limited, healthcare power of attorney is one thing, a limited financial power of attorney is another. When it's all set up right, you don't really need a power of attorney because it's in the trust. If it's in the trust, who has control over it? You're right, the trustee. Okay. Next question then. If the trustee has power over it, who is the trustee of your trust? You're right, you are. Well, if you became incapacitated and were declared incompetent, or when you die, the next person in line is called your successor trustee, and you've already designated who that's going to be. So that's how that works. Okay. Power of attorneys, just be careful, get good legal advice. Just make sure the reason why you're getting one, and if it's really that important. And if it's limited, that's even better. Next power of attorney is going to be for healthcare decisions. Sometimes this is called a physician's directive, a healthcare power of attorney, a health directive, all going to be one document from my office. And that's going to delegate the authority to make medical decisions. It's going to allow someone else to make medical decisions for you. That's going to be used in the event of your incapacity. Super important. Doctors want you to have one usually recorded online. They're going to want you to take it into their office. If you go in for some major surgery, the doctor's going to want you to have a power of attorney put in place that's going to allow somebody to make healthcare decisions in the event of you being non-communicative. In that power of attorney, we also have what's called the physician's directive or the health directive. And that's going to say whether you want to be on life support if you're in a coma, whether you want to donate your organs, whether you want to be, have your body, you want to be buried or cremated. And let's see. Oh, and whether you want to authorize an autopsy. Those are things that are your statement of desires in that power of attorney. And it helps whoever's your power of attorney, it helps them understand exactly what you want. And that's the important part. You're trying to leave instructions for somebody that's going to take care of you. Now, when you leave the instructions, the person's that's taking care of you, it may not be that you've died. It may be that you are incapacitated. Okay, so we want to make sure that everything covers you, even if you're incapacitated. Okay. All righty. The next thing you're going to need is a deed to transfer your house into the trust. This is called funding, and it must be done. If it's not done, your house is not in the trust, your trust is not funded, and technically an unfunded trust is invalid. So we don't want to invalidate your trust to start out. We want to make sure that it's funded. When you're doing a trust review with me, for my listeners, you can do that at 855-500-TRUST. You get a free review, and I check to see if your house is in the trust. The other things that you want to make sure you have are your life insurance. If you're the age and health and everything where life insurance makes sense, that can add to the size of your estate. So if you're young, you're worried about not having much equity in your house, you just have a mortgage, or maybe you have no house, but you're concerned because you have a dependent spouse and maybe dependent children, then you want to seriously consider life insurance. When you're young, it's super cheap, super affordable, and you can get some big policy limits so that you can take care of your family in the event that you pass away. So I think those are things to think of. Those are the 10 things that need to be in your estate plan. The trust, the will, the healthcare power of attorney, the trust certification, the guardian designation, the financial power of attorney, the deed to the trust, a deed to hold your home as community property, and life insurance and healthcare directive. That's it. We're going to have Rich Mathurin from GQ Law coming up next year on the Word on Wealth.
You've got questions. We've got answers. This is the Word on Wealth with Gary Quackenbush of GQ Law. Gary's here to give you peace of mind with expert estate planning, trust administration, inheritance, and probate. Call Gary to build, protect, and transfer your wealth. 855-500-TRUST. GQLaw.com. Of GQ Law. Call or click to request your free initial consultation or to talk with a member of the team. Call Gary at 855-500-TRUST. GQLaw.com.
You're live.
All right. Welcome to the Word on Wealth. Hey, as I promised, we've got Rich Mathurin from GQ Law. He's going to be here for this part of the show right to the top of the hour. And we're going to be talking about tax situations. That's our deal on Mondays that we have promised. So what we're going to do is, if you have questions regarding a tax situation that you may have, or incognito, a friend has, just give us a call at 888-344-1170, 888-344-1170, and you can be part of the show and ask Rich a question of your own. So in the meantime, what I'm going to do is, I've got some questions. One of the things that happens, and it's kind of, tax time, the final tax deadline for filing your tax returns is October 15th, because that was kind of the extension to the extension that everybody got because of the pandemic and all the things that's going on. So I wanted to go over with Rich the situation of, what about unfiled returns? And so let me just start out by asking Rich, do you Do you find very often in your practice that people have like failed to file their tax returns?
It's a almost weekly occurrence.
Okay. And it seems like, we all know we're supposed to, that my tax return is due on April 15th. What do when you see people that haven't filed, are we talking people that haven't filed in 2 or 3 or 4 years or 10 or 15 years? What have you seen?
It runs the gamut. Usually it's a number of years, 5, 10 years. A lot of times, just people just get behind and kind of bury their head in the sand and think that that they're so far behind, why start filing now? But you really can get yourself into trouble if you don't file your returns.
Right.
It's a lot of number of things that can happen that are none of which are good when you don't file.
So these are things where, because I know when you talk to people about, not filing returns, and I know there are probably people listening to the show going, that's ridiculous. I file my returns every year and everybody knows it's tax season. Is it when people get behind, do they just have this attitude like, I'm so far behind, I'm just helpless, I can't do anything about it, so I'm just never going to file again?
I think that's the case. Also, probably they have significant tax balances that they owe in the past years and figure there's no way they could pay them. So why file? The thing that you need to avoid is that if a taxing authority gets income information regarding you, that would be a W-2 or 1099, and they can prepare their own returns for you. I think we've talked about these in the past. It's called the substitute for return with the IRS, or a notice of proposed assessment for the California Franchise Tax Board. And what they do is they take that income information, they give you the standard deduction, and then they tax you at the highest rate. Then they add on all the interest and penalties for the year, for the time that you didn't file and not filing and all of that. Those substitute for returns, notice of proposed assessments, those balances are usually significantly higher than if you had your own tax preparer do them yourselves. And plus, they're not dischargeable in a bankruptcy if you ever needed to file bankruptcy in the future. So they can have a lot of negative consequences.
A lot of negative consequences to not filing. So then if you, like, let's say, somebody hasn't filed in a whole bunch of years, and they really just don't know, if they had any income. They don't remember they were self-employed for a while. They know they were maybe they were working carpentry for a while. Maybe they were, I don't know, just whatever. Maybe they were in kind of their self-employment thing going on, and maybe they had some wages. Is there a way to actually go and figure out whether the IRS has any information on a person?
Yes, we can get a power of attorney for the IRS for the client. And then we can run a tax report for them that would show the last 10 years of income, 1099 W-2 income that
Wow.
the client has earned. Also, our tax enrolled agent can run their tax transcripts to see if they have, any income too. But I think the tax report's the easiest way to do that. Again, it shows 10 years of income information, also kind of gives you a breakdown of what they think is taxable. So a lot of times, there is income. I think that's the way that people probably do avoid taxes, where they are self-employed and don't have W-2 and maybe paid under the table or whatnot. So
Let's talk about that a little bit on, because you're saying W-2s, 1099, that the IRS would have it. Well, so each employer, I guess we call them payers. So people that pay other people, whether it's an employer or whether it's somebody that, the general contractor paying it, a subcontractor, or an individual paying somebody. If somebody gets paid more than $600 in a year from one person to another for business purposes, that's supposed to be reported on a 1099. So I guess what you're saying then, that 1099, they're supposed to send it to you, the person that received the money, and they send it to the IRS, and the IRS can have that record. So if the IRS has records of 1099 income, miscellaneous income, then that might be enough for them to trigger, like, say, making up this a substituted return that you're talking about.
Yeah, that's generally the case with the IRS. I think we've talked about this before. The Franchise Tax Board, the California Franchise Tax Board, goes even further than that. If they get, I think, what is it, a 1098 mortgage interest statement?
Yeah, mortgage interest
Or
statement.
if you are a business that has a license under the license by the California Secretary of State, they might take your industry. If you're like a hairdresser or a plumber or whatever, and you haven't filed your own return, they might take the average, hairdresser in San Diego County and attribute that income to you. And or with the mortgage interest rate, I've seen them multiply it by 6. So if you paid like $20,000 in mortgage interest, and they get a statement from a mortgage broker, a finance company on that, they can multiply that 20,000 by 6 and get you attribute $120,000 of income to you. So it's very,
Wow.
very again, those are bad situations happen when they do these substitute for returns or these notice of proposed assessments.
So if the state of California, they go in, they have their record of the 1098, the mortgage interest, the statement that says how much mortgage interest you paid. They multiply it by 6. They put that on this dummy tax return that we're calling it. And if there's any W-2 wages, if there's any 1099 income, if there's any, I guess, interest received on investments or anything like that, they're going to know about it and they're going to put it on a return.
Yeah, like I said, the FTB is very, very aggressive. I have seen them do 6 years of notice of proposed assessments where the IRS maybe doesn't catch up until later or doesn't ever do it. But they use these special ways to attribute income if they get any inkling that you have had income in the past. I think they're really focused on the last 3 years. IRS would be focused on the last 6 years. So just be aware of that. And again, I think one thing that we've mentioned in the past is if you do have these substitute for returns or these notice of proposed assessments, I would suggest getting with a tax preparer and fixing those returns. Generally, the IRS and the FTB, as long as everything is done properly, would accept those. They wouldn't be an amended return, but a replacement of your own return in substitute for that substitute for return or notice of proposed assessment. Unfortunately, even if you do replace it, those wouldn't be dischargeable in a bankruptcy in future years. So do need to keep that in mind. But I think we've mentioned this before. I've had clients that owed $160,000 in taxes. We had our enrolled agent fix the tax return, and the tax bill went down to like 50,000. So it saved him $110,000 in both state and federal income taxes. It's huge.
Yeah, and I think that the reason for that is because if you're married, they don't consider you as married. They don't look to see if you're married. They don't care if you have any dependents. They can put you as the highest tax bracket. They can just say, well, we know at one time this person was married, so we're going to assume that he or she is still married, but not filing with the spouse. So we're going to put you as married, filing separate. Maybe it's the highest tax bracket. We've seen people where they file normally as a head of household, which is a really low income tax bracket. And yet the state comes in, the IRS comes in, and they just assess a dummy return, a substitute for return, like Rich is saying, and they're coming up with these really, really high numbers. Now I'm going to ask Rich. So if you want help with this, the number's 855-500-TRUST. You can call and you can talk to Rich, get an appointment with him or with me, and we'll talk about your tax situation, see if there's a way to resolve it. If it's you or if it's a family member, let's get it done. Because if you haven't filed returns, now's the time to get going on it, because you got the end of tax season, which is October 15th, and next tax season ends April 15th, which is 6 months later. So we're going to get kind of all piled up here if you don't get those done. Now, the one thing that we do want to talk about, and that's going to be coming up next year, is if you didn't file your returns and the IRS filed them for you or the state filed them for you, and now they were going after you, what can you do? Because that's the scary thing. You go check your bank account, the balance is 0, and it says on it, federal government or state government on your bank statement, and now that money's gone. Is it possible to get it back? How do you get the tax liability set up? What do you do? So that's the next thing I want to ask Rich about is, what are the options if you have not filed returns? What are the options available besides getting the tax returns filed? Do we file them and then ask the question? Do we file, or do we wait until we got the answers? Coming up next year on the Word on Wealth, more tax problem solving with Rich Mathurin. Call us at 855-500-TRUST.
You don't need to know everything. You just need to know where to find answers you can trust when you need them. Welcome to the Word on Wealth with Gary Quackenbush. We're here to help you build, protect, and transfer everything you've worked hard for with expert estate planning, trust administration, inheritance, and probate. Call Gary and the team at gqlaw.com. 855-500-TRUST.
Gary, how do you and your team help our listeners avoid probate?
Well, first of all, probate is a process that involves attorneys, judges, and sometimes contesting parties. And so we try to avoid probate at pretty much all costs. The way we do that is setting up living trusts, setting up properly documented wills, putting the property like houses, cars, bank accounts in that trust so that it avoids probate. Probate is only necessary if the estate plan isn't set up quite right. So we help them get it set up right. And mainly that's done through a properly created living trust.
Call Gary and the team at GQ Law, 855-500-TRUST, or go online and download Gary's free ebooks and videos. Read Gary's blogs. Call or click to request your free initial consultation. That's gqlaw.com, 855-500-TRUST.
Hi, folks. Dave Stahl for Gun Owners Radio. We'll be telling you everything.
You're not alone. Ask for the legal help you need. Call Gary and the team at GQ Law, 855-500-TRUST, or go online and download Gary's free ebooks and videos. Read Gary's blogs. Call or click to request your free consultation or to talk with a member of the GQ team. That's gqlaw.com, 855.
You're live.
Welcome back. You're here on Tax Monday. We've got Rich Mathurin of GQ Law. Happy to have him along so we can kind of sort this mess out with unfiled or backfiled tax returns. We were talking about the IRS, if they have information regarding like W-2 income or 1099 income, which is self-employment income. If they have that information, they can put together a tax return for you. It's a dummy return. It's basically a bare assessment. Rich, we talked about that with the IRS and then with the state, where the state is saying, well, based on an industry average, you earned X amount of money, plug that in a tax return. And we found a 1099, plug that on a tax return. And we noticed you had mortgage interest. We're going to put that times 6 on the tax return. If the IRS and or the state does that and prepares these dummy returns, what do they do? Can they actually go and try to take that money from you now?
Yeah, absolutely. That's an assessed tax balance that they can collect upon. You can accept. We've talked about fixing those dummy returns and submitting your own returns, but you can accept them, and the IRS and or the FTB can do collections on them. Seen it very, very many times. They have, that's an assessed tax balance that they have assessed against you that they feel you owe. Again, unless you fix it or maybe do an appeal or possibly a tax court petition or things we talked about. But it's a lot easier to just fix it, submit your own return, and get the correct tax assessed.
And so it's not like you can really hide. I mean, if if the IRS has reported income or this IRS state has reported income, they're going to make an assessment eventually. And it may be that it's been a couple of years, right? Right. The IRS sometimes it's 3 years, 4 years later. You may think you've gotten away with it, but when it comes home to roost, usually they're going to be all caught up. So if they can collect the taxes, then you're saying, Rich, what you're explaining is that if somebody gets the correct amount prepared on their tax return, that they can submit that return, basically file it, and that would then go in place of this substituted assessment or this notice of proposed assessment with the state. Is that correct?
Yeah, I talked with our enrolled agent about that, and he said maybe you have to submit some extra supporting document, but he's never had a case where if you do fix a substitute for return or notice of proposed assessment where the IRS and or the FTB didn't take that corrected amount as your new tax assessment. So it really pays to fix those.
Okay. And that's the thing that I think is important, you guys, and what we want our listeners to understand. And this may not be you. It may be, a friend of yours. It may be somebody that, you go to the auto shop and he's complaining about, oh my gosh, things are so tough. I haven't even filed my tax returns. Sometimes this is the stuff to spread the word on. The IRS during the pandemic really slowed down on what they were doing. I mean, it was a matter of, for a time, the IRS was and all we know is like Southern California. They were, they're filing, 10 or 20,000 liens. I mean, there's times when the IRS was filing tens of thousands of liens across the nation. And during the pandemic, they filed 0. I mean, their collection activity stopped. It came to a screaming halt for a couple of years, but they're back on it now because the money somehow the government has to have enough money to feed the fire, right? I mean, our federal government has been handing out money by the trillions during the pandemic. And that money, where did it come from? It came out of the tax coffers. There's only 2 organizations in the federal government that make money net positive. One is the
DEA.
That's right. The DEA. Crazy, because they sell the vehicles and all that and pay the problems that these drug people have caused. And the other one is the IRS. So if you think about it, and I've had to explain this to people, because I don't know if I've told you this before, I probably have, but I've had clients that will challenge me and say, Gary, you really think taxes are constitutional? You really think, because it's only for, IRS employees, and they're showing me the code sections and all that. And my explanation was always more realistic. And this has been my whole career. More realistically is like, okay, let's think about it. The IRS has been collecting taxes now for decades. It now has this deficit, the highest that it's ever seen in history, and it's growing. Is the IRS going to be more inclined to try to collect money or less inclined to try and collect money? Basically, you have this, the government is addicted to taxes. They're not going to suddenly say, oh, just kidding, these aren't constitutional. It's not going to happen. They're going to collect the money. The IRS is going, when they find somebody that there's some wealth out there, there's some available, whether it's equity in a home or whether it's wages or a bank account sitting there. They don't even care if it's retirement accounts. If there's money and you owe, they're going to attach it. Now, like Rich is saying, that if there's, if that's happened and now the IRS suddenly attaches your money, it's not uncommon for somebody to say, I don't even owe that money. Where did they come up with these numbers? And the answer is simply, the IRS looked at your return and it wasn't there. So they prepared one for you. And now they got this assessment and they can, just go and collect that money. And the IRS collects $13 trillion a year. And that's on a good year. Okay. That's on a normal year. That's how much they spend too, the government. So they got to collect a lot of money. So they are not going to be easy. But Rich's solution, and I know what he's going to say, is if somebody does have a tax problem, what's your advice?
Again, I would suggest getting with your tax preparer. You can, we have our own that we recommend to our clients, or use your own and prepare all of your returns, both federal and state. And then probably best to hold them and come in and speak with us about, get a solution, whether it's an installment agreement, whether it's an offer in compromise. I don't think a bankruptcy, because you have all those missing returns, would be, but maybe a bankruptcy, maybe a non-collectible status. Maybe you just can't afford to pay any of the taxes right now. There are a lot of different options available, but again, we need to prepare them, have a plan once we file them, and then get them filed, and then, contact the taxing authority to get into some type of arrangement, because they will not go away. They will garnish your wages. They will levy your bank accounts. They will place liens on all of your assets in the county in which you live. So there are a lot of collection methods available to them.
So if somebody then has a tax problem, if you want to call, if you want help with it, you want to get your options, the number is 855-500-TRUST. You can get an appointment with Rich and talk to him about your tax situation, 855-500-TRUST. If you have your favorite tax professional, go to them, ask them to get you caught up, and if they've been bugging you for 5 years to do it and you've just ignored them, go back and say, I'm sorry, mea culpa, and let me get these tax returns filed. Get them ready, get them prepared. And then I suggest, and I totally agree with Rich on this, is get in here to look at your returns, not to like check and make sure they're okay, but just to see what we can estimate the balance due and the penalties, so that we can come up with a solution so that you can then file your returns and be ready for when the IRS and or the state come back and try to come after you. And Rich has been really good about setting up payment plans like early on. The whole idea, and I'm going to have Rich address this for a minute, is like, as far as like jumping on this, have you found, and I know it probably speaks for itself, but does it really make a big difference to kind of like get ahead of it and work with the IRS, or are they still going to be brutal, just like as if they'd caught up to you?
No, if you file your missing returns and you contact them and you try to get into some arrangement, whether again, it's a payment plan, you might qualify for an offer in compromise. Maybe a bankruptcy works for you. Maybe we could get you into non-collectible if you don't have the current ability to pay, but they want you to, they want you to deal with the past, and they want you to get in compliance going forward. That means filing all future returns and things like that. But if again, it's not going to be pain free, but it's going to be a lot less pain than having your employer notified that having a garnishment, or seeing that you had $10,000 in your bank account and it suddenly is gone. That you don't want those things to happen.
Yeah. And that stuff happens. I mean, it's if we were making this stuff up, it would seem unrealistic, but my gosh, I know it seems like, really, the IRS is going to take all of your money. Well, if you owe them money and they figured it out, they're going to take all of your money. To get it back is always a bigger challenge than trying to keep them from getting into your bank account. Now, the one thing, and this is really important too, is sometimes we've had people that will come in and they'll say, I had no idea. The IRS, they didn't mention anything to me. I didn't receive any notices. I didn't receive any bills, and they took my bank account. How could that be?
Well, that's probably the case where you moved and you didn't notify them of your change of address. And as long as they mail to the address that they have on file with you, that satisfies their notice requirements. So they did notify you. You just didn't notify them if you moved. So, they do have to notify you of collection activities, but if they're going to use the address that they have on file, and that's sufficient.
Isn't that wild? That's so true, because their due process with the IRS, there is, quote, due process. It's just limited. And if you didn't tell them, and if you haven't filed your tax returns for years, you haven't told them where you moved, because nobody does. I mean, you don't move and say, I'm not going to file my return next year, but I'm going to certainly tell the IRS my new address. It just happens. So yes, it is possible to get a wage levy, a bank levy, a lien filed, and not have any idea that it happened because you didn't get notice. The IRS is going to say they notified you at your old address. Well, if they really didn't, that's a problem, and that's going to be an appealable thing.
One other collection activity that's pretty easy that I've had a lot of clients complain about is now from the 2015 Transportation Act, they can hold your passport. They can have the State Department hold your passport, I believe, if you owe $10,000 or more. So that's another way that that comes up. People try to go to Puerto Vallarta, and they're not able to because the IRS has put a block on their passport.
All right, we'll be back tomorrow here on The Word on Wealth. Thanks, everybody. Bye.
Tell a friend about the Word on Wealth, featured since 1995. With financial solutions attorney Gary Quackenbush, an expert in estate planning, wills and trusts, and tax problem solving. Gary is past president of the California Society of Tax Consultants. Reach out to us. The Word on Wealth team of financial experts is here to answer your questions and help preserve your family's financial future. The information you hear on the Word on Wealth is for general information purposes only. This program discusses general financial and legal topics. Seek legal advice from a competent lawyer for your individual legal needs. The opinions expressed here do not necessarily represent the views of Salem Media Group or its sponsors.
The airing of
Thank